A lot has been happening in the capital market of late, and most investors are losing money. The ongoing Middle East conflict has disrupted critical energy supply chains, pushed oil prices sharply higher, and triggered volatility across equities, bonds, and even gold. But while equity markets have been under pressure in the last 1 year, bonds and commodities like gold and silver have performed better. And this brings us to a very important lesson for investors. Relying on just one asset class can be risky. If that one segment underperforms, your entire portfolio takes a hit. That's exactly why diversification becomes so important. It helps you navigate uncertainty and aim for more balanced returns. Now, this is where multi-asset allocation funds come into the picture. These funds give you a structured way to diversify your investments across different asset classes like equity, debt, gold, all within a single fund. By spreading investments across multiple assets, these funds try to balance risk and return more effectively. Fund managers actively adjust allocations based on market conditions to manage volatility and optimize performance. So, what exactly are multi-asset allocation funds? They are a type of hybrid mutual fund that invest in at least 3 asset classes with a minimum of 10% allocation in each. Their main goal is to generate moderate capital appreciation while reducing overall risk through diversification. Typically, they combine assets like equity, debt, and gold, which usually do not move in the same direction at the same time. For example, equities tend to do well during growth phases. Debt and gold may perform better during uncertain times. So, when one asset underperforms, another can help cushion the impact. Another key thing here is active management. Fund managers may continuously adjust the portfolio based on factors like equity valuations, interest rate outlook, macroeconomic trends in India and globally, and the quality of the underlying investments. This dynamic approach helps maintain a balanced portfolio across changing market conditions. Let's talk about the advantages. First, diversification. Your risk is spread across multiple asset classes. Second, professional management. Expert fund managers handle allocation and rebalancing for you. Third, convenience. You do not have to track and time different asset classes yourself. And finally, these funds aim to deliver relatively more stable returns across market cycles compared to pure equity funds. Fund managers also have flexibility in building the portfolio. They can invest across different market caps and sectors for the equity portion, choose debt instruments across duration and credit quality, and gain exposure to gold through ETFs or derivatives. Some funds even include assets like REITs and InvITs, silver, international equities, and cash. But of course, there are risks too. Since these funds invest in multiple assets, each component comes with its own risk. Equities can be volatile. Debt can be impacted by interest rates, credit risk, and liquidity. And commodities like gold can fluctuate in price. Also, because these funds are diversified, their upside may be limited. So, in a strong bull market, they might underperform pure equity funds since they do not have very high equity exposure. So, to wrap it up, multi-asset allocation funds offer a balanced way to invest by combining different asset classes into one portfolio. They help manage uncertainty through diversification and active management while aiming for stable, risk-adjusted returns over time. These funds are generally suitable for investors with a moderately high risk appetite, looking to invest for the long term, ideally 3 to 5 years or more. They can also be a great option for first-time investors who want a balanced approach without taking excessive risk. Just make sure the fund you choose aligns with your financial goals and overall asset allocation strategy. For more insights on mutual fund investing, subscribe to the Equitymaster YouTube channel. Happy investing! Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Registration granted by SEBI, enlistment as RA and IA with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.